Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CELESTICA INC quarterly report. CELESTICA Inc. provides a wide range of supply chain solutions to various industries worldwide. The company's services include product manufacturing, design and development engineering services, component sourcing, electronics manufacturing, and assembly testing, mechanical assembly systems, integration precision machining, order fulfillment, logistics, asset management, product licensing, aftermarket repair and return services. Additionally, Celestica offers hardware platform solutions, IT asset disposition, and asset management services, open source software development and customization, program management, including design and supply chain, manufacturing, and aftermarket support. The skyrocketing of Celestica Inc.'s stock price. A year of exceptional growth, Celestica Inc.'s stock price has experienced a remarkable surge of over 331.42% in the past year, driven by strong financial performance and strategic positioning in the artificial intelligence, AI, data center infrastructure market. Key factors contributing to this significant increase include exceptional Q3 2025 financial results, with revenue reaching $3.19 billion and GAAP earnings per share rising to $2.31. The company's role in supporting AI-optimized networking racks has been crucial for its performance, with the Connectivity and Cloud Solutions (CCS) segment experiencing a 43% increase in Q3 2025 compared to Q3 2024. Celestica's upward revision of its 2025 and 2026 financial outlooks, projecting revenue growth of 31% and 39%, respectively, has also contributed to the stock price surge. Additionally, strategic program awards, operational leverage, and margin expansion have all played a role in driving Celestica's success. The acquisition of NCS Global Services LLC in April 2024 has enhanced the company's service offerings and expanded its market reach. Analyst sentiment and outperformance have also contributed to the stock price increase, with analysts giving Celestica an outperform consensus rating. Overall, Celestica Inc.'s exceptional financial performance, strategic positioning, and optimistic future outlooks have driven a remarkable surge in its stock price over the past year. The primary drivers of revenue growth or decline are multifaceted, reflecting both internal operational improvements and external market dynamics. On the growth side, key factors include a significant increase in cash earnings, business expansion in the CCS segment, favorable non-cash recoveries, and higher-than-expected customer demand, particularly in the communications end market. Additionally, operating leverage has been stronger than anticipated, and investments by leading hyperscalers have contributed to revenue growth. On the decline side, factors include the discontinuation of a margin-dilutive program, decreased demand for capital equipment, and a technology transition affecting AI/ML compute programs with a major customer. These drivers highlight both internal operational adjustments and external market shifts that impact revenue performance. Net income and profit margins. A shift in favor. The financial summary reveals a significant increase in net income and profit margins for the company. In Q3 2025, net income rose by $56.8 million from Q2 2025, while year-to-date, YTD, 2025 saw an increase of $339.2 million compared to YTD 2024. The net income also increased by $186.9 million in Q3 2025 compared to the same period last year. Profit margins also showed improvement, with gross margin increasing from 12.8% in Q2 2025 to 13% in Q3 2025. The ATS segment margin rose from 5.3% to 5.5%, while CCS segment margin remained flat at 8.3%. Gross profit increased by $155.5 million in Q3 2025 and $324.5 million in YTD 2025. The impact of Pillar 2 global minimum tax legislation is mentioned as a possible reason for the changes, but further analysis is needed to understand its full effect on the company's financial performance. The company is generating a significant amount of positive operating cash flow, indicating its ability to generate sufficient funds from its core business operations. For the 3 months ended September 30, 2025, net cash provided by operating activities was $126.2 million. This trend continued for the 9 months ended September 30, 2025, with a substantial increase to $408.9 million, although the year-to-date YTD figure for 2025 shows a decrease to $33.4 million. It is essential to consider this in the context of the overall performance. Overall, the company's positive operating cash flow suggests its financial health and ability to sustain its operations. The company's debt level has undergone significant changes over the past year. While total liabilities initially increased by $485.9 million, reaching $4,578.1 million in 2025, subsequent adjustments led to a decrease in contract liabilities and borrowings under the credit facility. Specifically, the original principal amount of Term A loan decreased from $350 to $250, while Term B loan increased from $365 to $500, and revolver increased from $600 to $750. Regarding interest expenses, there has been a notable increase in finance costs, rising from $11.2 million Q3 2024 to $12.8 million Q3 2025. Additionally, annual interest expense and fees under the credit facility are estimated at approximately $46 million. The company's financial performance varied across different segments and regions. The CCS segment stood out as a top performer, with a 43% increase in revenue and a 55% surge in income in Q3 2025. The communications end market also saw significant growth, with an 82% rise in revenue. Additionally, the HPS revenue increased by 79% to approximately $1.4 billion. On the other hand, the ATS segment struggled, with a 4% decline in revenue in Q3 2025 compared to the previous year. The enterprise end market also experienced a downturn, with a decrease of $148 million, 24%, in Q3 2025. Furthermore, the capital equipment business within the ATS segment saw a 5% drop in revenue due to decreased demand. These results indicate that while some segments and regions showed strong growth, others faced challenges in Q3 2025. Management is optimistic about the company's outlook, citing opportunities for growth in AI/machine learning programs. They expect revenue increases in certain businesses and end markets, particularly with artificial intelligence technologies. However, they also acknowledge potential challenges from inflation and global economic trends, which may impact margins. Despite these uncertainties, management believes the company is well-positioned to adapt and keep pace with technological developments. The company has made several acquisitions and divestitures over the past few years, impacting its financial performance. Acquisitions have resulted in costs of $300,000 to $1,200,000 per year, with higher costs in 2024 compared to 2025. Notably, no specific details are provided for one acquisition. On the other hand, divestitures have generated significant revenue. The sale of Toronto real property in 2019 was a notable transaction. Additionally, the company has discontinued a margin-dilutive program and sold accounts receivable, /R, to third-party banks, generating $13.3 million and $76.8 million respectively in 2024 and 2025. The company has made significant investments in share buybacks over the past year, with a total of $336.6 million spent on buying back shares. It is clear that the company has prioritized returning value to its shareholders through this means rather than paying dividends. The substantial amounts allocated for share buybacks in both the 3- and 9-month periods demonstrate a commitment to maximizing shareholder wealth through this strategy. Concerns about inventory buildup and supply chain disruption are mounting. Inventory levels have surged, with significant increases in raw materials, work in progress, and finished goods. This has led to higher inventory write-downs and decreased cash deposits from customers due to excess or obsolete stock. Furthermore, potential supply chain disruptions loom large, driven by material, component, and supply chain constraints. Uncertainty surrounding trade actions and restrictions adds to the risk of delivery delays caused by port congestion and labor shortages or strikes. These issues threaten to disrupt the smooth flow of goods and services, with potentially far-reaching consequences for businesses and economies alike. That concludes the financial summary for CELESTICA INC. Feel free to comment below, and I will be happy to answer them when possible.